Okay, so there's quite a lot on here. This is a balance sheet. You also need to know how a balance sheet works and the construction of it. So you start off with non-current assets up here. So in this case, the non-current assets come to 1 million quid. Pretend this is the campsite to make it nice and easy for you. Current assets, and your question on the exam will be on a campsite. So, okay, current assets are also an asset, but anything that can be converted to cash quite quickly. So in here, we've got £50,000 worth of current assets, £30,000 worth of stocks, which is relevant. At the same time, you have current liabilities, which is creditors. Okay, this will then give us a figure of net current assets. So your net current assets here are minus 50,000 quid because you've got £100,000 worth of current liabilities, £50,000 worth of current assets. Okay, from this bit here, we can get the current ratio and the asset test ratio. We can get three things from a balance sheet. Current ratio, asset test ratio, and also gearing, which is down here. Okay, so in this case, your current ratio is just current assets divided by current liabilities. Current assets, 50,000, divided by current liabilities, therefore is 0.521. Okay, pretty straightforward. The asset test ratio is cash plus debtors divided by creditors, which is 100,000 quid. In this case, that is 0.221 because we do not include stock in this. So it's a tighter control on the business. The current ratio should be 2-to-1. The asset test ratio should be 1-to-1. So here we have a liquidity problem if we look at this balance sheet on here. Working capital is the amount of cash we have in a business, which is always just current assets minus current liabilities. So your net current assets is the same thing as working capital on here. Non-current liabilities are your long-term loans. Right, to get net assets, we take off the net current assets, which happens to be minus 50,000. Obviously, we take off the loans because that's a liability. So the amount that this firm is worth is 700,000 quid. Now, how has this firm been funded? Well, we've got £700,000 worth of equity and retained earnings. So this is part of your capital employed. Your capital employed is non-current liabilities plus this plus this. Okay, so once we do this plus this, that comes to 950,000 quid. 100,000 plus 250,000, and then you put the long-term loans on top. So your gearing ratio is non-current liabilities divided by non-current liabilities plus retained earnings plus equity, times it by 100, and that will give you your gearing.